Hi, everyone. Chad and Davi back at it again with the latest installment of BaseFirma's podcast on Brazil's alignment with OECD transfer pricing standards. BaseFirma is bringing you this podcast as your go-to transfer pricing firm in the Americas and beyond. We've got offices located throughout the Western Hemisphere and Europe, alliances with elite transfer pricing firms worldwide, and we are your one-stop shop for everything transfer pricing, from planning to implementation to compliance to audit and controversy. So we're excited for today's episode because we are moving beyond the theoretical, beyond the background, and into some of the actual specifics of certain cases for our clients and taxpayers in general on how these new measures, the new provisional measure, which is expected to be passed into law any day now, within the next 4 weeks max, will affect everyday operations for these companies. So today's episode specifically is going to be on the hands-on practicalities of how the new measures affect multinational enterprises with intra-group tangible transactions. So let's dive right into it. Davi, let's start with a brief reminder on the methods that were available under the historical Brazilian transfer pricing, rules in Brazil for tangible product transactions.
Yeah, I think that, Shad, this is really important to put everyone on the same page, because as I told on the previous podcast, our rules were designed to test tangible goods in Brazil, and that was the main thought that the legislator at the time, when was writing our rule, was thinking about, was to preserve the Brazilian transfer pricing industry at the time. So you remember I told you that on back on 96, Brazil was open its doors to the world, and the Brazilians was really afraid of the external competitors, because our industry at the time, and it's not so different nowadays, but our industry was not that competitive. So we are really afraid of that, and we put some barriers to take care of this domestic industry and to take care of the local profitability. So we designed those methods, and we split them, the methods to test the transfer pricing in Brazil, in two. Methods to test import transactions and methods to export transactions. They are basically respecting the same model like resale minus. There is this possibility of apply a margin on the resales, the cost plus method, and some methods for the comparison. We do have, so for import transactions, the main method in Brazil, still today, is the resale minus method. This method in the beginning was designed to test two transactions, the import for resale and the import for production. And you need to comply with this method on a product by product basis. That's another special characteristic of our system. So you can imagine, for an industry, let's assume like GM or Ford in Brazil at the time, who was importing auto parts to assemble an automotive here. So for each one of these parts, they needed to calculate and to apply a transfer pricing method. Resale minus was the largest used by far, because all the information was available here in Brazil, was domestic information. So back on that time, on previous from 2012, the legislation established these two different models: 20% for resale, 60% for products that will be applied on the production process in Brazil. It creates a huge problem, because even the word assembling was put under dispute in Brazil. There was some industries, for example, that was like a pharmaceutical industry that was importing the finished good, the pill. But here in Brazil, they are put in a box with a label and a blister, and it is called production for Brazilian transfer pricing purpose. So you can imagine that disputes was always a problem in Brazil based on these methods. And fixed margins. Fixed margins was the rule for all those methodologies for import and export transactions. So on imports nowadays, we do have the resale minus with three different margins. The first one is the 40% margin that is for pharmaceutical industry, for oil and gas. This is the top margin that is required here in Brazil. 30% is for chemical industry, and 20% applies for whole other industries, independent if they are working with tangible goods or with services. All industries that are not in the 40 or 30%, there are a list that establishes a list of entities who are in these business sectors should be allocated in the 20%. We do have also the PIC method, that is like the cup method in the US. We used to say that Brazil has been inspired by OECD, but we changed a little bit our rule. So it's quite confusing when we say that these methods could be comparables. But in the Brazilian transfer pricing rule, we do have this comparable method, but is a comparison per transaction. So each imported item, you can compare this actual price or exported item with a foreign third-party price. So that's a possibility. And we do have also the cost plus method for imports that allow taxpayers in Brazil to pay for a product the cost plus a maximum of 20% markup. What's the problem? Document those transactions is a lot of work. To prepare the documentation based on the resale minus method, we do need to use softwares to run these calculations on this product by product basis. On the other hand, for export transactions, we do have the same. So for each exported product, we have the cost plus method that is the largest used because all the domestic information is here available to comply with that. 15% is the markup that is requested. We have the resale on the other country that allows taxpayer, depending on the markets that the product was resold, to apply a margin maximum of 15 or 30% if it is a wholesale or directly sale on the foreign markets that the product was resold. And we do have the PFAX that is similar to the CUP method, similar to the PAC method, the comparison. When you are exporting a product to a third party and the same products to your related party, you can compare, and if the prices are equal or lower, you are good to go. No adjustment would be necessary. And we do have also two methodologies, specific methods to test commodities. Is the PCI for import transactions and the PSEX for exports. So you need basically to test each transaction on a separate basis, on a daily basis, or per transaction to establish if your export price is arm's length or not, based on the Brazilian principles. That's basically what we do have here.
Great. Thanks for that background, Davi. And one thing I hear from taxpayers quite a bit is, I'm not too worried about the switch over from an implementation or from a documentation standpoint because Brazil's methods all have OECD or US method analogs, right? So for example, I've been using the CIP for my Brazilian transfer pricing. I'm just going to switch over and use the CUP for OECD method transfer pricing, right? I've been using the cost plus for Brazil. I'm just going to switch over and apply, the OECD cost plus method. Any notes of caution from you? I'm guessing there are on taxpayers who might come in with that mentality.
Oh yeah, it could happen. And because what happens is that, as I told you on the previous podcast, we do have this provisional measure as like a copy and paste of the OECD guidelines. However, we need to translate it to Brazilian Portuguese to make it valid in Brazil. And we stay with the same names of the old methods here in Brazil. So resale minus method is still the PRL, the preço de revenda menos lucro. It's an acronym for resale minus. What happens is that this confusion can happen, and we are as consultants, we are really afraid that the taxpayer thinks that is that simple. Yeah, we'll just keep the same methods. We are just turning the key, and we will keep complying with the transfer pricing by applying just a different method. Our methods nowadays are mathematical formulas. You can imagine that you do have on the rule what you need to do for each component. What are the percentages? What are the multipliers? What you need to include or exclude? And is there written down. However, now with the TNMM, for example, there is no actual formula. You do need to perform a deeper analysis. You do need to perform an economic analysis to make this comparison of the transactions really arm's length. So in this situation, I'm really worried that the Brazilian taxpayers thinks that will be just a changing on the name, but we can keep the same methods. For example, the PAC method, as I just told you, is a comparison nowadays on a product by product basis. On the OECD, it is not. It's a comparison of the transaction. So this, I think that one huge effort from the Brazilian taxpayers that they should pay attention is on the preparation of its teams to understand what is coming. The training of these professionals will be essential to not making mistakes that could cause a lot of problems to the company.
I think you're spot on there, Davi. And one thing that I've really been trying to emphasize with Brazilian taxpayers and with maybe U.S. tax personnel responsible for Brazilian operations is, first from an implementation standpoint, exactly as you mentioned, the Brazilian TP calculations are very formulaic, right? It's a mathematical formula. It's not analogous to a fully loaded cost plus markup, right? That you might see more commonly in an OECD or a US transfer pricing implementation standpoint, where you're maybe looking at, cost of materials plus some sort of, standard costing process, right? With labor and overhead and all of this layered on top, right? So it may be analogous, but there's a pretty good chance it's not going to be a direct correlation to how the cost buildup was being done before. For this example being applied to using a cost plus method for implementation. Then there's the other side of it that you also hit on, that for Brazil, implementation, the calculation, and the compliance were unified, right? The way you calculated your prices from an intercompany accounting or implementation standpoint was the same way that you documented later. With OECD and US transfer pricing, and the commonality of using profit-based methods, like you mentioned, the TNMM or the CPM in the US, you've got a little bit of a divergence, right? You set your cost plus policy from an implementation standpoint, right? You apply, let's say, a 30% markup on the cost, the materials cost of your product. Then you go back in and test the transaction on a net margin basis, right? So did my cost plus 30 from an implementation standpoint get me to a full cost plus 10 markup if I'm looking at a net margin basis, which is how I'm looking at my comparable companies for the profit-based method, right? I think that's potentially another pitfall that we could see, from companies making the shift from Brazilian methods to the analogous OECD and US ones.
Yes.
Great. Davi, another question for you. So on a similar note, I think you alluded to this a little bit. One of the things that was very unique and particular to Brazilian transfer pricing was this concept that you have to pick one of the prescribed methods, right? You have to use the markups that are available to you based on the industry and based on the circumstances of the transaction. But the key point there is you get to pick it, right? You can choose the method that is most advantageous for you as a taxpayer at the end of the day, right? Obviously, selection of the most appropriate method in the OECD, selection of the best method in the US, that is completely contrary to both of those, right? So what pitfalls, what challenges, what disadvantages, what opportunities do you see in this switch over from being able to pick the method that you apply to having to select a method based on facts and circumstances?
Yeah. That was the two pillars, in my view, that support this change on the Brazilian transfer pricing rules. That is the double taxation and the non-taxation at all. The double taxation relies on the fixed margins that we do have here in Brazil. So there is a lot of companies that even on the 20% margin, that is the lower margin on the resale mines, are not able to comply, are not able to compete, and did result in transfer pricing adjustments. What those companies do is try to change to alternative methods, the PIC, the cost plus, any other methods that would result in a lower tax adjustment or non-tax adjustment. That's the second problem. So in your hand, we have the double taxation, and in another hand, we have the non-taxation at all. That would be a good situation for those taxpayers that do have economic substance to support the alternative methods as the best method for tested transaction, but it's not the case. In Brazil, some taxpayers has abused of this opportunity to choose the method, and even with no profit at all on the international transactions with related parties, they don't ever a transfer pricing adjustment in Brazil because they were using the alternative methods, this possibility to change the methods, to choose the best method for their perspective, to make the adjustment lower or make it zero. We know that this practice was one of the key points that OECD raised the hand and say, hey, this does not work. Fixed margins does not work, but given the opportunity for the taxpayer to choose the methods that they think that is the best one, is not even close to an arm's length principle, because they will always look for their own transactions, because this is what happens. Everybody will try to make as less taxable as possible their transactions. So that happens a lot, and Receita Federal and OECD come up with this solution that is avoid this kind of possibility in Brazil. And this result also in another problem, and that Receita Federal and OECD just solved it in the first moment. That was some taxpayers in Brazil was looking for an hybrid model. Say, hey, our rules are not a problem. So for those taxpayers that want to keep the old rules, we can keep. And for those taxpayers that want to do the OECD, they can move to the new system. But this will jeopardize all the efforts that Receita Federal and OECD put on this project to make this alignment, to make our rules really fair and predictable, not only for the Brazilian taxpayers and for tax administration, but also for the other countries that are making business with Brazil.
Thanks, Davi. So, in sum, a door closing on a old and probably unadvisable tax planning opportunity, and using Brazil transfer pricing rules and OECD transfer pricing rules arbitrage, right? But also on the flip side of this, kind of this relief from the double taxation that also could result from that same concept, right? And we've seen countless ways over the past 5 or 6 years of tax authorities outside of Brazil trying to attack, some of those double non-taxation, opportunities, if you will, or problems, right, from their perspective, through various methods, right, either through income tax related methods, transfer pricing methods, the denial of the foreign tax credit in the US. So definitely some certainty, right, but not necessarily an unalloyed advantage or disadvantage to all taxpayers. So, Davi, I want to put you on the spot here with an actual question that I've received from one of our clients. I'm going to paraphrase it here. This is an industrial manufacturer, right? And outside of Brazil, they have been using a transfer pricing policy where they bundle costs of the product, the product price, the intangibles for the manufacturing process of the product, and also a component of technical services into the overall sales price of the product, right? You mentioned kind of the calculation for Brazil never really allowed for that under historical rules. So This is a pretty common process for countries and jurisdictions that follow OECD or US transfer pricing regulations, which allow for that sort of bundled pricing. Do you have any considerations, any thoughts on how converting that policy into the Brazilian context going forward might work, whether it would work? Any notes of caution from you?
Yeah. We know, Chad, that a lot of companies did that in the past in Brazil, working with the old transfer pricing rules, but it was all part of the actual price component, the price that will be comparable to any one of the parameter price established by the methodologies that we do had in the that we still have today. Uh, what is the trick point at now? The companies would be able to split that. That could be a problem under a customs perspective. I know that if the company has historically performed this intercompany price based on a bundle, considering also some intangible parts on the price of the product, it could be a problem now to split it. But for the new lines, for the new products, they now can split it because one of the main reasons that the company used to do that in Brazil was the royalty problem. We are not able to submit and to pay royalties abroad. It was like up to 5%, and depends on the transaction. You know that this limit is way below what is expected to remunerate the technology, to remunerate the quality of the products, the quality of the item that was sold to Brazil. We know that nowadays we do have an opportunity for those companies that want to start this analysis by splitting the price of the good and the intangibles that are there, because Brazil will now accept the payment of the royalties based on the OECD, based on the arm's length principle. For the past, we know that some companies in Brazil were trying to comply with that, and the alternative methods was a problem when we are talking about cost plus, for example, because here in Brazil, it was the company was able to consider up to 20% markup, but there was a necessity to break down this cost on a really detailed level. And when there is any component of intangibles inside of the cost of the good, this component was not considered for the cost purposes in Brazil. So that was the main situation, the main problem in the past. I think that now it is addressed, and with this new OECD model, we will be able to address, to be in compliance and considering also these specific transactions from abroad.
I think you raise a really interesting point about customs valuation and potential customs audits, right, Davi? My question for you, obviously, there's going to be extensive training for Brazilian tax authorities on the OECD methods. Do you foresee similar training and similar alignment with Brazilian customs officials on these new methods of, pricing and valuing product transactions under OECD methods?
I do see, and on 2022, there was a normative instruction from Receita Federal. I don't know if they are already predicting this changing to the OECD model, but the Brazilian transfer pricing studies from that day forwards will look also to the transfer pricing documentation that was prepared by the company. So the customs valuation will take a look on your transfer pricing documentation to make sure that the prices of the product was properly designed, was properly calculated. So that's something that we do need to pay attention. Customs and transfer pricing will now walk with hands more close and more together than in the past in Brazil. There, I think that the legislation was a little bit in conflict.
Very interesting. Appreciate that insight, Davi. Last question for you. So, prevailing guidance that I've been hearing from, service providers, from industry experts is, unless there's a really compelling reason, it would be pretty difficult from an administrative standpoint, from a, just general coherence standpoint, to adopt the OECD standards now, especially before the law is passed. First of all, running the risk that for whatever reason the measure fails before June 1st. Second of all, just the short time frame that you have before September 30th to actually elect and implement an OECD model for fiscal year 2023. Do you see contexts where you actually might advise a taxpayer to go ahead and adopt the OECD option for fiscal 2023?
Depends on, yeah, it's not a clear answer, Chad. Unfortunately, I will put my consultant cloth and say that depends on their transactions, depends on the historic of the company, depends on the profitability that they had in the past years, depending on if they want to change the functions, the risks that they are carrying in Brazil, and if they have enough time to do that in 2023, that I don't think so, because we are already quite in the middle of the year. So what we are suggesting to our clients is to take a look on your figures of 2022, understand if there is any substantial change for 2023, and based on this analysis, the 2022 figures, try to apply, try to understand which would be the scenario if the provisional measure was issued last year. So take these numbers in a perspective, understand, and make the comparison with your actual transfer pricing that the companies must feel during the income tax return now on July 31st. So you now have a clear view based on that numbers. With the 2023 figures, based on what we do have now, I think that will be a gray zone for most of the taxpayers to make this decision on September.
Thanks, Davi. It obviously wouldn't be a transfer pricing discussion if we didn't have at least one "it depends" in there, right? So appreciate that. I think the point you raise is great. That it's not off the table, right? But it would take a tax department with very sophisticated and very timely, very speedy ability to do that qualitative, quantitative assessment in the next couple months. If they haven't started already, it's going to be really difficult, right? So great considerations there. Well, folks, that wraps up today's podcast. Hope you enjoyed listening to Davi's insights on tangible transactions in the context of Brazil's alignment with OECD transfer pricing standards. Sneak peek for episode 3, we're going to be discussing intragroup services. So Davi, thanks again for joining me today. Thanks again for everyone who listened, and we'll look forward to seeing you on the next episode.